Hello everyone, my name is Diaan Bansrai and welcome to Finance, Facts and Fiction. You often hear that you have to invest money to make money. And on the financial market it's not that different. You buy a stock and you hope that in the future you can either sell it for a higher price or you earn dividends on that stock. But when is it a good choice to buy a stock and sell it in the future? Can we just compare what we pay today to what we receive in the future? In this video, I want to explore two important concepts in finance. The first is time value of money, which essentially asks, can we compare cash that we have to pay today to cash that we earn in the future? Or how should we compare those two amounts of cash? And the second is compounding, the effect where money may grow faster, faster and faster the longer you invest. So let's get started. Let's first think about an example. Let's say that today you want to become a DJ, so you spend some money to buy your equipment. And then after some practicing, maybe in a year's time, you'll be able to play at a wedding where you earn some money. Now, do we think that the money that we earn in the future has the same value as the money that we earn today? And to see why this is maybe not an easy question, let's look at some intuition. So what do you prefer? Do you prefer $100 today or $100 in 1 year? Now I think most people will choose $100 today. But what if I change the example? You can either earn $100 today or $200 in 1 year. Now if you do not need the $100 urgently, for example for groceries or rent, you may prefer to wait and go for the $200 in 1 year. Because then you've received twice the amount. And in a similar situation, you can think about either earning 1 million today versus 2 million in the future. Now, I think most people will choose to double their money and take 2 million in 1 year's time, because that's a great deal. But what now if your choice is between 1 million today and $1.05 million in 1 year time? It's still $50,000 more, so that's a lot. But maybe some people might not feel that they still need to wait that entire year and just prefer the 1 million today and take any interest that they have on their savings account. So how should we understand what we prefer in these different situations? Now it's clear from these examples that we sometimes prefer today's value and sometimes we prefer the value in the future. So this shows us that the value of $1 today is not the same value as $1 in the future. And this difference is what we call the time value of money. The value of money today is called the present value and the value of money in the future is called the future value. Now this time value of money formalizes the relationship between value of money over different periods in time. And it helps us to understand whether we should go for that investment in the DJ equipment or many other decisions in life or in business. For example, it may help you to decide between studying first and working later or start working today. Similarly, when people buy phones, they may choose to take out a loan to pay the phone over different periods in time, or they want to pay the phone now. And it may also help you to decide between keeping your old car running or buying a brand new car. And also in corporate decisions, we often have to invest in a factory or in a new product before we can get the revenues and the profits from these decisions. So there's always a difference in timing between when we have to invest and when we can earn the money. So let's go through an example. If I put $100 on the bank today and receive a yearly interest of 5%, how much is my $100 worth in 1 year's time? Now what I always first do is I draw a timeline. So today I've got a value of 100 and want to know what this value is worth in 1 year's time. Now I receive 5% per year, so I can do a small calculation where in 1 year I will have my 100, which is still at the bank, plus I'm going to earn 5% on this 500. So that gives me a total of 100 plus 5, which is 105. Now we can also write this as 100 times 1.05. And now we find that the future value is equal to $105. We can also reverse this example. Let's say that I receive $100 in 1 year. How much would that be worth today? And let's assume that the interest rate is still 5%. Now in 1 year it is worth 100, so that's my future value. But I have to think a little bit about the amount that should grow today with 5% to become $100 in 1 year. And that present value of that amount, we can find that by dividing 100 by 1.05, which is about $95. So then we can say that with a 5% interest rate, $95.24 today has the same value as $100 in the future. And what we just did is we traveled through time. But there are a few rules when it comes to time travel in finance. Rule 1 is only values or cash flows or cash at the same moment in time can be compared or combined. So if we earn something today and we have to pay something today, we can add those two amounts together. But if we have to pay something today and then we earn something in the future, well then we have to make sure that these amounts of cash happen in the same period. So, and that brings us to rule number 2. To move a cash flow forward in time, you must what is called compound it. And we can calculate it, and it may look a little bit tricky, but what we actually do is we take the value of the cash flow today, which we call C, and we multiply that by 1 plus the interest rate, for example, the interest rate on your savings account, and we raise that to the power n for the number of periods that we need to move something forward or backwards in time. So then we get C times 1 plus r to the power n. But what if we want to think about cash flows that happen in the future, what the present values of those cash flows are? And that brings us to rule number 3. To move a cash flow backward in time, you must discount it. So the present value of a cash flow is then equal to C divided by 1 plus r to the power n. So instead of multiplying with this 1 plus the interest rate, we divide by 1 plus the interest rate to the power n. Now let us try to illustrate this with an example which maybe feel a little bit more intuitive. So let's say that if I put $100 on the bank today and I receive a yearly interest of 5% like before, we can ask how much is my $100 worth in 3 years' time. So today it's worth $100 and I know I receive 5% on this $100 and each year I receive 5% on my previous amount. So in the first year I receive 5% on 100 and in the second year I receive 5% on 105. So in 3 years it will have grown to 100 times 1.05 to the power 3, which is about $115. And we can also write this explicitly by saying that this is equal to 100 times 1.05 times 1.05 times 1.05. So we let our money grow 3 times with a 5% interest rate. Now what's happening here is that each year we earn 5% on our initial amount of 100, but we also earn 5% on the previously earned interest. And we again can look at this in a timeline. So today we have 100 and in 1 year it grows to 105. In the second year it grows to 110 and in the third year it grows to about 115. But if we look at the actual amounts with which our savings increase, we can see that in the first year we earn 5, in the second year we earn 5.25 and in the third year we earn 5.51. So what's happening here? Why is this amount increasing each year? And this is the effect of compounding, a snowball effect. The longer we wait, the larger this effect will be. So we can again think about this example of $100 today, which we grow with 5% annual interest rate. And after 10 years, this amount will have grown to about 163. After 20 years, it has grown to 265. And after 40 years, it has even grown to more than $700. Now we can show this effect in a figure. So where in this figure, the bottom red bars show that each year our initial amount stays at 100. Now the middle bars, which are in orange, show that we earn $5 on our initial amount. So in the first year we earned 5, in the second year we earned our previous 5 plus another 5, which is 10. So each year this amount increases by 5. But then there's this effect of compounding, where in the first year we do not earn anything on any previous interest because it doesn't exist. But in the second year we earn 5% on that $5 which we earned. And this effect is accumulating over time, but it grows larger and larger and larger, and in year 40 it's the biggest contributor to our wealth. And this is displayed in the yellow bars on top. Now what I want to make sure that you have as a takeaway from this figure is that this accumulating effect of interest on interest is a very strong effect, but it becomes stronger with time. And we can also think about what would have happened if we had invested $100 in the S&P 500 in 1982. Well, if that were the case, then it would have grown to almost $1 million today. But then again, if we look at when this growth takes place, then we see that in the first 20 years, we only earn about $117. So we double our amount, but it isn't a huge growth. But if we look at the growth effects in the last 20 years, we see that our portfolio increases with more than $800,000. And this is a huge effect. But all these effects come very late in time. And that is why investing in a very long time horizon and starting to save and invest early might be valuable. But we have to consider a few things. First, you want to strike a balance between living today and living in the future. With the time value of money, we're only saying that investing $100 in 1928 in the S&P 500 is about the same value as having $1 million today. We're not saying that one of the two choices is better, but it's up to you to determine how you want to use your financing. And if you have some savings left over, well, maybe then this effect of interest on interest or this compounding effect may be very valuable. But also two things which are often forgotten. And one is inflation and the other is risk. So this is what I want to have a look at next. So let's first think about inflation. And inflation means that prices increase over time. So if today we can buy a loaf of bread for $1, then maybe in 40 years we can buy less than half of it. So we need more money to consume the same, to buy the same items that we do today. And to put inflation to our examples, well, going from $100 to 1 million, that sounds like a lot. But in real terms, so adjusting for inflation, it represents only about $54,000. So don't get me wrong, that's still a huge increase, but it's not as big as increasing from 100 to $1 million. So we have to take inflation into account. Going back to our example of saving on a bank, we can think about an average inflation rate of 2%. Now, if that were the case, then our $704 on the bank would only be worth $319 in real terms. So when we think about long-term investing, we also want to think about the effects of inflation. And the second component, which is super important when you think about investing, is risk. Even though your value grows over time, every day your portfolio is at risk. And what we mean is that it can either go up, but it can also go down. And this may change on an hourly, daily, month or yearly basis. So in this graph, I show the annual returns on the S&P 500 from 1928 until 2024. And what you can see is that yes, in most years, you might have a positive return, but there are also years when your returns are negative. Now imagine that you're close to retirement in 2021 and you saved a lot by saving on the bank and on the stock market, and your stock market portfolio is worth $1 million. Now you need this $1 million to pay for your future rent or housing expenses, for food, but also after retirement you may want to travel and do some fun stuff. But what can happen in a year's time when you maybe need to work for one more year? Now your portfolio may drop to 800,000. So this means that you lost 20% of your portfolio value in just 1 year. So I want to stress that even though the cumulative effect, the compounding effect of interest on interest is very strong, every day your portfolio may still be at risk when investing on the stock market. So to wrap up, fact or fiction? The fact is, saving early is important for your long-term wealth. The fiction is that it is easy to spend money today and catch up later, and this is because of that compounding effect. Yes, it may be true that later in your life you have more money to save because your income may have increased, but the effects of compounding will be weaker because you're closer to retirement. And the second fact or fiction of today is the fact is compounding is a very powerful effect in the long run, but the fiction is that because of compounding there's no risk or effort needed in the long run. We have seen that still on a monthly or annual basis your portfolio value may decrease, and if you need that money to pay for your housing or living expenses, you want to think about these risks carefully. So today we've learned about the time value of money and the power of compounding. But in the end of the video I discussed a little bit about the effects of risk that may still influence your portfolio. Now in the next video I want to spend a little bit more time on what we mean by taking risk and what the relation is between taking risk and potential returns that you may earn on the stock market. I'll see you then. Bye. Thank you for watching. I hope that you liked this video and that you learned something from it. If so, please like it, share and subscribe to this channel, and I'll see you in the next video.